And today we will focus on asset allocation, what kind of strategies we can employ, and what works and what doesn't. What's the myth, what's the realities? I also work with Financial Planning Association. It's a non-profit organization that supports financial literacy. I work with them tightly on library project that we're doing today, and also a few others. Financial Planning Association supports financial literacy education in the communities through foster children outreach, through people who are going through difficult times like divorce or health issues. We're trying to help them as volunteers. And I'm very pleased to be here and very excited to share some information with you today. So let's start. Before we start, I'll let you know that we have this worksheet available, Asset Allocation Strategies for Life, and that helps you to take something home and start working through the information you received today. And I'll explain to you what it is. Basically, when we talk about asset allocation, we first need to find out what's our asset location. Where do we keep our money? How much we have in cash and stocks, bonds, annuities, all kinds of investments. And this worksheet will help you to identify those: retirement account, non-retirement accounts. Why do we need? Maybe you already have that. Maybe you don't. If you don't, this is a great way to organize it. Why do we need it? Simply because it's very important for us to get an understanding how much we have in each bucket. When I say bucket, I mean how much I have in cash reserves, how much I have in my intermediate term bucket, how much I have in the bucket that gives me a long-term returns like retirement accounts. I'd also call it longevity bucket. That bucket will keep us going once we retire for the next 30 years. And once we identify all of these buckets, we can now see if there's any buckets are insignificant and we need to increase them. Maybe emergency funds are too low or too high. Maybe we keep too much in savings accounts. Or alternatively, we can decide maybe we are not properly invested and we're taking an unnecessary risk, or we're not taking enough growth approach in the portfolio to keep up with inflation. So the worksheet too will help you to identify how you feel about the risk and what makes sense to me. It's also a very good way for you to revisit risks, especially in this current volatile market. I personally have a system. It's on my website, and I can share my website link with you at the end of the presentation. Then you can go under resources and click on what's my risk score and take a personal risk assessment to see where you are at compared to what's your risk of your portfolio. So that's also very helpful to identify maybe potential pitfalls in your portfolio allocation. So that would be that. And then we will start talking about what makes sense in the current market environment, what works, what doesn't. And if you have any questions, I'll be happy to answer. I will be glancing at the chat once in a while, but probably majority of my answers will come toward the end. I will address most of them. It's a very lengthy presentation, so I'll try to compact it into about half an hour, maybe 40 minutes, so we'll have enough time for Q&As. So I'll be skipping some slides that I believe not significant, and we'll go from there. So this is the survey of professional forecasters versus actual yield. So let's talk about interest rates. It's on everybody's mind and everybody's agenda. So people talk about rates a lot, and they try to set expectations what the interest rates or yield will do in the next 6 months, in the next year. And unfortunately, it's very difficult to predict. The back line is showing that interest rates, the actuals, what is actually being, and the gray and yellow and all kind of colored lines showing the average forecasters. So you see how much forecasts deviate from actuals. So predicting interest rate is very difficult. And the reason I'm showing it because I want everybody to understand how difficult it is to really put your portfolio the way that the interest rates are going. Meaning, if we know for sure how much interest rates will rise, we'll allocate portfolio this way. But unfortunately, we don't know. And because of that, it's always better to create a portfolio that whether any kind of interest rates hikes or interest rates stability or decreases. Right now, as we know, Federal Reserve will continue to raise interest rates to tame inflation. Inflation has been running high for a number of reasons. We won't go into all of this today, but we do know because of the constraints in the supply chain, because China closed down recently, also because we have so much money in circulation because of stimulus package. We printed a lot of money in 2020. Also because of energy prices increased due to war in Europe. All of that created the perfect storm for non-transitory, how Federal Reserve originally said, but for a little bit more prolonged inflation. We still do not see that inflation will be that high for a number of years, like in toward the end of 1970s, beginning of 1980s, for a number of reasons. But we do believe that there will be inflationary trends and inflation will be a problem for the next year or two. Maybe it will subside slightly. There is a reasons for that, but in general, it will be higher than what we've seen in the last 10 years. Today, we'll talk about optimal portfolio for all time horizons. Myth of should we avoid core bonds if interest rates are rising, which is probably on everybody's mind, and style and size, and I'll explain what that means and does it give us edge or not. Active management, broad international exposure diversification, should we have the money there, and defensive equity or stock approach going forward. Thank you for the comments. I am reading them. Nobody blaming China here, by the way. We're just saying that they locked down for COVID, right? Which is a fact. All right. There is no really a lot of political, information here in this presentation. We just talk about what makes sense, what we see. This presentation was built by Fidelity Investments with their help, so I would like to greatly appreciate it. There's a lot of good information here from years of experience. What is efficient frontier is basically saying how do we optimize risk reward, and where should we put our portfolio? So if your current portfolio is this gray dot, it means that it's not sitting in efficient frontier. Efficient frontier where you're taking so much risk to get so much return. The explanation to that would be, for instance, I took a lot of risk to put all my money in Tesla stock, or in Microsoft, or in NVIDIA. And I expect, because of this huge volatility and risk, a lot of return. So risk and return has to come in hand. If I'm taking a lot of risk, but I'm getting very little return, this is called not optimized. In that case, portfolio will be right here. It will be off this line. So the less risk, the less reward. This is your volatility measures to the right, and this is upside return. So our goal is to stick to as little as possible to the left side with minimum volatility and increase our return. So the more risk we're taking, we should have a higher return. So this is called efficient frontier. It's been developed by French in Pharma, Chicago School of Business years ago, and it's been one of the probably greatest financial work in the last 50 years. So we want to really allocate portfolio the way that it has good risk reward, we call it. Now, asset allocation. So depending on the business cycle, there is a different way of allocate your securities. So the blue line is showing your business cycle, and depending how you allocate, depending where you are in the business cycle, there is a proposition of allocating your securities differently, going into different places. So let's just look at the big business cycle approach, what it means. So for instance, if we are in economic growth, a lot of companies that developing US, Asia, India, they're all will be, a place to go because everything is pushing higher. So you want to be in a more risky investments. As we approach a late cycle, like US was in a late cycle, maybe we're approaching contraction, we need to start thinking about decreasing risk in your portfolio to a certain degree, or at least evaluating it. So business cycle approach is very important because in the late cycle, where we are right now, economy growing moderately, earnings could be under pressure, even though we've seen earnings reported yesterday and day before yesterday, they're still pretty strong for a lot of companies. Nevertheless, majority of companies might have a pressure on their earnings. policy contradictions and increased interest rates. So right now we're seeing it all where we are in a late stage of a business cycle in the United States. Whether we will go into recession or not, very difficult to say. It's usually a toss of a coin for economists to predict. But in general, we can say that if we are approaching recession, we need to be a bit more conservative, and that might be a case today. So this is showing that stocks are blue, bonds are green, and cash is gray. Different performance of different asset class. What is asset class? It's basically bonds, stocks, and cash. So you can see in the early cycle, stocks play a huge role and they grow the most. You can see return 20, 25%. In the mid and late cycle, the stock performance goes down, but the bond performance actually holds pretty well. But look what happened in recession. People right now, everybody hate bonds. They say bonds are the worst, bonds are not good, they're not making us money. But in reality, if we do go into recession, the best place that holds the value are our bonds. And you can see the stocks have negative return. Cash is consistent across the board, but unfortunately, cash is not keeping up with inflation. This is a very interesting chart. It's showing how investors have tendency in general in their 401k accounts at least to chase the past performance. The dark gray line showing S&P 500 and the green lines showing percentage of new contributions to stocks that performed well in the past. And that's why you can see that average performance or average investor lags the index because everybody wants to chase that hot stock or hot fund. In reality, actually, once you've seen a great performance in one fund, it's a very high chance that fund will not perform well in the next 5 years because it's very difficult to outperform all the time. And this is showing very similar pictures, so I will skip that. So this is a very interesting chart. It's showing do-it-yourself investors' performance. And it doesn't mean you don't need to do it yourself. You just need to be aware of the psychological impact of particular thinking that it may have on your portfolio. Again, the let's say wealth reference target, it's your, we call it efficient market frontier, or your kind of, something that you want to stick around with the best risk reward. The kind of dark blue is 60-40 portfolio, 60% bonds, 60% stocks, 40% bonds. And that's showing right here in your dark blue line. And in the kind of dotted line or the broken line is investor portfolio in general. So you can see how it's trying to mimic the market, but it does outperform. And one simple reason is because a lot of times we make decisions about investment, how we feel about the market, how we feel about the economy. So when the market is down, the economy is shaky, people tend not to invest. They don't see the opportunities in the stock market where the stock prices declined. They walk away from it instead of thinking, well, the stocks are down 10% or 12%. Some individual stocks are down by far more than that. Maybe there is a time to reevaluate, rebalance, to see where can I take advantage of this particular dislocation of the stocks. Another unique thing about the way we build our portfolios is our aversion to pain. So you can see here that when we experience losses, our pain aversion is extremely high. Feeling pain is much more unpleasant than having enjoyment of positive returns. So the positive returns pleasure is by far less strong or less intense to us than when we're losing money in the market. So that's called loss aversion. Loss aversion overweights the gains. And because of that, people make decisions maybe not exactly how they're supposed to based on just the numbers. I want to show you this map. This is very interesting map. This map is showing you, depends on different, we just took different mutual funds as an example, and we showed how much it has correlation with overall stock market. So if you invested in, let's say, Fidelity Advisor Insight Fund, which is US companies, or mid-sized companies, Vanguard Total International Admiral Fund, you can see that all of this red has a higher correlation to overall US market risk measures. But if we're looking at something like high yield bonds, AB High Yield Income Fund, it has a very low correlation to stocks, meaning when stocks doing A, bonds doing B, so they're not related to each other. Why this low correlation can be a very good diversifier? Because when the stock market is going down, bonds have their own life. Even though we have to say that year to date, both stocks and bonds are down, they're down for a different reason. And because of that, bonds most likely will behave very differently than stocks in the future. And creating a low correlation, having low correlation bond in the portfolio will give you a chance to allocate some funds, especially if you're retired, toward the areas that's potentially can create more stability in the future. So bonds are not something we completely want to throw out of our portfolio, even though at this time. So we'll bring it all together and show you some other interesting statistics. So investor behaviors from 113 through 2016. This was actually the time, if anybody remembers, when the bond, we saw a huge bond outflow, and the bonds people were dumping bonds because there was some, muni bond tantrum, and people were worried about interest rates as they are right now. And you should see the following year how much bond have made in the next 2 to 3 years. When bonds are so sold out, like as of today, you can see that if you are a brand new investor and you're conservative investor, bonds right now are at a very, very big discount. And expectations of interest rate increases already embedded in the bond prices, expecting interest rates 7 or 8 hikes in rates. And it's probably more overdone in the bond prices. And because of that, it's created a dislocation and potential opportunity for those investors who are seeking yield. A lot of retirees rely on yield and dividends, and bonds do provide them a stability, security, diversification, and also yield. So we can talk about different types of bond funds and what makes sense, but as it stands today, bonds are not maybe not going to make us a lot of money in the future, but they would definitely, as interest rates increase, will provide higher yield in the next few years. I'm showing you a 10-year treasury rate. Right now, it's increased by 2%, very dramatically. And what we're seeing today, that 10-year treasury yield is slightly higher. 1-year treasury yield is slightly higher than 10-year yield. And that concerns a lot of economists because it's what be called a flattening yield curve, or if at some point it becomes inverted, a lot of times it's one of the predictors of inflation. Historically, it's been a good predictor of inflation. Right now, things have changed. So it's by far less predicting of the recession that it was before. So this is one of the indicators we're looking on besides everything else. But it's something good to see because it's very easy to find. So let's look into when interest rates rise, what bond returns can we expect? So you can see in 1968, bond returns were negative when rates went up. This is your 10-year treasury, and you can see 78 and 1980s when the interest rate went a lot up, the bonds were still making money. So there are times, few years, maybe couple, in the when we see what the worst annual return can happen, which is 3.2%. But you can see on average, bonds do make money. Of course, they're not going to make us 10, 11% a year, but they do potentially provide for long-term investors stable return. And as interest rates increase, our yields that we'll be collecting of bonds will also increase. Hopefully, many of you looked in their allocation and know what kind of investments you have. I think if we are going into recession, having some sort of bond allocation is prudent, especially for those who are approaching retirement or retired. All right, so let's look at this bond return versus interest rates one more time. So we see annual return, we see bluish yield, and we see the returns. So the majority, I would say 75% of the time, bond produce a positive return, and there's only a few times, and this is the maybe the slide that's showing you that year to date we will have a negative return most likely on bonds. How much? Hard to say, but I think it's going to be a couple percentage negative return for 2022. Going forward, I want to quickly let you know that since we're Californians, we're in a higher tax brackets, municipal bond allocation is very enticing to those who are in higher tax brackets. And a lot of Californians, even being retired, experience 15-20% tax brackets. And because of that, municipal bonds, especially California bonds that federal and state tax-free, present a great opportunity for investors. And the reason for that is because you don't have to pay neither federal or state tax. And because of that, you're saving a lot of money in taxation by allocating your bonds into municipal bonds. Plus, California received a lot of support after COVID from federal government, and their credit quality of their bonds has increased dramatically in the last couple of years. So default rate in municipal bonds is extremely low, which means once we buy municipal bonds, we have a higher chance to not to lose the money versus corporate bonds, right? Government bonds are not paying much money. I'm talking about, treasury yields, very low. Municipal bonds still paying good yield in today's environment. Corporate bonds paying similar yield than municipality, maybe a little bit higher, but you would experience greater risk because companies can go out of business, corporation can do well, might not be doing well, where municipalities are backed up, a lot of them backed up by the state or the federal funds. I would like to go over a couple more things. We talked about the bonds. Now let's talk about we call it different asset classes: equity, fixed income, alternative investments, and really see some breakdowns. This call it sectors. So the sectors is something that's probably will drive majority of your performance in the future. So you really need to pay attention where you are at. And I want to bring something to your attention as of the moment. When economy is improving and soaring and doing really well, that was 2021, right? Because of we had so much money printing because we were coming out of COVID. 2021 was a very good year in the stock market. And consumer discretionary usually do really well. Information technology, telecommunication, real estate. So all of these sectors were doing extremely well. Now, when we have a fear of recession and when economy is slowing down, even though expected GDP, gross domestic product, is probably going to be still in a positive number between 3% and 3.5%, we see some slowdown. And as a result, one of the sectors that we need to pay attention to is consumer staples and healthcare. These two sectors considered defensive. And when we are worried about slowdown in economy, these sectors, we call them value stocks, start to perform better. If you look at any comparison chart of growth stocks, we call them FANG stocks, right? Facebook, Amazon, Apple, Google, we can see them struggling year to date. Where the value stocks, look at any healthcare stocks, you can see that Merck, one example, Eli Lilly, and all those, you can see that they've done actually pretty good this year. Berkshire Hathaway, that's another example. So they're doing much, much better than the growth stocks because they're defensive. They pay dividends. They're in the sectors that are not sensitive to recession as much because we still need medical care, we still need our drugs, we still need our consumer staples like CVS Pharmacy and Johnson & Johnson and Procter & Gamble products. So that could be a very good diversifier and also risk reducer in your portfolio. So we need to pay attention which sectors we're in inside of your portfolio. 78% of your performance are driven by sectors and the company factors. So that's a huge percentage. Peter Lynch said a long time ago, founder of Merrill Lynch, he said that asset allocation dictates 90% of portfolio performance. And what's inside of asset allocation? That's exactly what we're talking about. The combination between stocks and bonds. How much can I take a risk? How much I can put in stocks? Once I determine that percentage, the second question is, in a stock area or in a bond area, where should I be? What kind of sectors I should consider? Do I stick to US large companies? Do I go internationally? Do I go into consumer staples? What would be the ideal environment for me at that time? And this all depends on your risk tolerance, time horizon, need for income, and also your risk assessment. You can see this is extremely busy chart, but what it depicts here is, depending on the right side, this is the color chart for each different asset class of sector, right? And it says year after year, you can see how it changes in performance. So sometimes materials perform really well, and then the healthcare is down. Sometimes healthcare is up, utilities up, and the materials are down. So because of that unpredictable nature of each sector class, we need to stay in the middle. We need to create a diversified portfolio that has majority of large companies in it, and not to make very big bets in different sectors. However, include those that currently economically make sense. And it's showing us again here, depending on the business cycle, what kind of sectors actually are good to have and good to focus on. Well, if you're thinking about late cycle we discussed today, you can see that materials, right? We talked about a bit of commodities, consumer staples, healthcare, energy, utilities usually do well. And then in the recession, you can see that even materials no longer needed, right? Because we don't need as much production. Then we see still consumer staples, healthcare, telecom, utilities, which usually not a good investment in an early stage when everything is going up, information technology, and etc. So it's a very good guide for us to see potentially how we can be tilting certain sectors in our portfolio. So now we will talk a little bit about active management versus passive management. My opinion on this, that it's very few companies do well on a long run to outperform the index. It's extremely difficult proposition, definitely not on a year-to-year basis. Some companies with some particular good research, there is only few of them and few funds. It's probably, I would say, less than 10% of the, I don't know, we have, I think, over 5,000 mutual funds, or even more than that, 6,000, and as much ETFs. Out of mutual fund universe, it's only few companies that have a very long time horizon, and they always transparent with their performance. Their fees are low, and it makes sense to allocate. Most of the time, investor can do really well allocating to index funds. The only decision investor needs to make is what kind of sectors potentially I want to include besides just being in an index. And this is more of an art than a science. But I do encourage you to think about cost of investing. There is two given things when we think about rate of return. If you want to optimize your rate of return, what do? There's two variables that you can control. Number one is the cost of investing. What is the expense ratios of every single investment I own? Number one, and that you can control. The second one is how much taxes am I paying after I earned my money? Is my investments tax efficient and tax aware? Or end of the year, I get 1099 and I see I haven't, even gotten any distributions out of my trust account, but I see a lot of distributions on the mutual funds because they're actively trading inside and they're producing a lot of capital gains. That might not be a good investment for your non-retirement asset, might be okay investment for your IRA because any trades inside do not produce taxable capital gains or dividends. So these two things are extremely to control, because the more you can keep in your pocket after paying taxes and after low cost, the better it would be for you. You don't need to take as much risk if you're keeping more in your pocket after all the fees been deducted and after all the taxes being paid. So I encourage you to look into those things because they're fully controlled. We cannot control the performance in the next 10 years of the market. Expectation that the market might not do that great compared to the last 10 years, yet to be seen. But we do need to see several areas as an opportunities. For instance, we're looking at the healthcare innovations. We're looking into artificial intelligence companies and companies who are focused on chip making, right? Semiconductor. We're looking at companies that are in a self-driving and electric vehicle business. That's also on the rise. So there are certain themes for the next decade are building up right now. Also increased middle class in emerging markets. So all of that creates an opportunity for us to research and potentially have better performance on the long run. Let's look at this chart. This is showing us basically, different industry 1 year excess returns net of fees. So this is active management and the passive management. And definitely the active management, does have a tendency to take a lot of risk. And because of that, they're trying to outperform the index. But unfortunately, their fees are high. And because of that, as a result, it's not always easy to beat the index. So I don't want to go into this busy slide, but the conclusion of active versus passive management is you should have both in your portfolio. And you need to have a philosophy. You need to have a idea about how you want to manage your money, and you need to be having it convincing enough for you to stick between good and bad times. All right, so we're getting close to about 5 minutes, and I'll be happy to take Q&As at the end. We'll talk about next one is international exposure and what works and what doesn't. If we look at the markets, you can see that market capitalization is US versus rest of the world. So there is a lot of money outside of the United States that invested in the stock market. There's a lot of good companies. So international markets actually present a very good diversifier outside of US. Unfortunately, in the last 15 years, what we've gone through, it's called globalization. And everybody probably knows that we've been receiving and trading with a lot of countries, right? We've got a lot of goods from overseas, from all over the world. We also send our goods, like technology, mostly out there. So there's been a lot of globalization. People are working and producing manufacturing facilities all over the globe, US producing know-how. So there's been a lot of globalization that created an environment where if we have an issue in US, it will be a hiccup overseas. And the same thing here. That's what COVID showed. When we have an issues overseas, this is where COVID started, we will have an issues in US. So globalization creates a very high correlation between different investments, whether they're US or non-US. But the tendency in the last couple of years after COVID hit, that we have something called deglobalization, where a lot of manufacturing plants have been brought back to US. We are net zero importer of oils. So we have majority of our oils actually our own local. So that helps this country to be a bit more independent. If something happens overseas, we have a little bit more stability for our own economy, which is, I think, it's a good thing for my definition. But because of globalization in the past, we started to see that international and US markets actually very related to each other. So a lot of people start thinking about, well, maybe I don't need to invest overseas because, they're all so related. If I'm investing in Apple stock, well, they are covering the rest of the globe. So it's really a global company. Google, the same thing. So as a result, international markets haven't been a great diversifier compared to the past. However, we need to realize that if we look at valuations, how expensive US market versus international markets, it's a huge divergence. We see US markets been one of the most expensive ones, however, the most stable at the same time, where international markets, on the other hand, right now is very inexpensive. So a lot of active managers saying that it makes sense to do the stock picking on companies like Novartis and Samsung, something that you truly believe that would be great companies to own long term, and they're not as expensive as their counter counter companies here in the United States in a similar field. So I do believe international markets present an opportunity. It also relates to the dollar value. As dollar goes down on value, international markets become more and more attractive. And I think it's something to look for. Unfortunately, the volatility of non-US markets is very high. And we're looking at emerging markets, we're looking into Asia, we're looking into Europe. So maybe it's not the time today to invest it, because we have most likely recessionary trends in Europe. They absorbed a lot of refugees, they have issues with the energy. But on a long term, I do believe that global markets is a great opportunity for investors. You just need to be comfortable with the volatility. A lot of investors have a US bias. I talk to Australian investors and they say, we love our Australian market because that's what they know. And same to us, we know this, we know our companies, we know our economy, we feel comfortable. So a lot of US investors are US biased. So there is nothing wrong with that. You need to invest where you're comfortable. But at the same time, you as the educated, well-rounded person, you need to understand that there is the rest of the world that also has a lot of potential opportunities in the different companies. So that's pretty much what I wanted to cover today. I have by far more than that. It's a very deep conversation on asset allocation. Every investor in general, every advisor, even I would say, would love to, get this asset allocation right every single year, but it's a really work in progress. So I will give you some ideas on it, how to approach it, what to look for. As a summary, I would say that we need to look at our through the worksheet on our own, what kind of allocation we have between cash, bonds, stocks, real estate, and determine, is that an optimal allocation? Do I have enough for emergency funds, for long-term care, for health care? Do I have enough for immediate needs, for my income needs, right? 5 to 10 years, medium time horizon. And what is my longevity bucket? Is it big enough? Do I need to take money out, or I can leave it alone and grow? And each bucket has a different risk levels. So that's number one. The number two is looking into asset allocation between your stocks and bonds. What's your risk number? And then the third one is to see, am I positioned for the late cycle of the business, for the economic cycle? And am I prepared for recession just in case? It doesn't mean you have to sell everything and go, but it means you need to maybe do small adjustments. So that's probably it. Let's see if we have any questions.
Yes, if anybody has questions, please feel free to enter them in the Q&A box or the chat box. And this program has been recorded, and I'll make it available to you in a week or two. It'll be on the library's YouTube site.
Great. Yes. Thank you, Lisa. It doesn't look like we have any questions yet. So should we wait a little bit more, or somebody, I don't know if you're allowed to unmute themselves, or probably chat is the best to go.
Yeah, I can unmute people if they would like to talk. I think somebody, Lisa's asking, what are your thoughts on high dividend mutual funds?
High dividend mutual funds. I like dividends at this point because if you remember, I mentioned that dividends is usually associated with the value stocks. And in an environment when interest rates are rising, the dividend paying stocks are one of the best performing asset class. So not only it increases its dividends, but it also gives you more stability. I give you one simple example. If you look at indexes for value stocks today, year to date, they're actually down maybe 1 or 2% only, where the growth stocks down more like 15%. So dividend paying stocks at this environment is very attractive. And I think they're also extremely important for retirees who live on income and they need to keep up with inflation. So yes, it's a great place to be at the moment.
Okay, there's another question. Somebody asked if you will email the slides. I don't know if we can email the slides, but definitely the presentation, the video presentation. And we'll also—
Yeah, slides, I'm not sure too, because it's built up for the advisors. So we have a lot of it. So I need to take it through compliance first. So I'm not sure, probably not.
Okay. But we'll also email everybody that worksheet.
The worksheet for sure, yes. Worksheet, happy to share, and I hope that it's going to be a very helpful material for you to kind of do a bit of homework.
Okay, and somebody asked, what are your thoughts on I-bonds or I-bond?
I-bonds, we're talking about treasury bonds? Because, yes, okay. So actually, they've been paying pretty good yield, I noticed lately. So I like them. It depends if the bond pays you 5% or so, and you can renew it every year or two, then for your security, for your safety bucket, this is the good investment. And I've been seeing it more and more that these bonds starts to pay by far higher yield than it's been before. So I've seen some treasury bonds start to pay very good yield on the Treasury Direct website. And that's a great place to actually look for any sort of government bonds. So as long as the bonds have a AAA or AA quality, which means investment grade quality, high quality bonds, and government bonds are AAA, then and paying good interest rates, I think it's a good investment. Just try not to lock them up for more than 3-4 years, because rates probably will increase, and if they increase, I-bond probably will pay higher rate.
And is there a limit of how much somebody can invest in an I-bond?
I believe there is something per person or per family. I believe there are some numbers I've seen and heard. That I don't believe they're very high, but exact numbers you can look at Treasury Direct. Thank you, Lisa, for sharing the.
May says 10,000 per person per year.
Yeah. So it's not a lot.
Okay.
Yeah. Per year. So see, it will take you time to build it up, right? 10,000 is not a lot of money.
Right. Yeah.
5 years not to lose interest, right? So right, but for your maybe for your extremely conservative portion, that's a good choice. 5 years is a little bit longer term that I would be comfortable, but also you don't need it's almost like CDs. You need to decide that I don't need this money, right? I just want that to keep up with inflation. In this interest rate environment, it's a little tough, but if I-bonds pay you 5% or so, then you're okay, because your inflation is covered. And again, depends what type of inflation you're looking. There's two types of inflation. One is called sticky inflation. Sticky inflation is inflation for rents, inflation for medical care that stick to us, and then we're really depending on that, right, for living in healthcare. And there is something called variable inflation, and that goes up and down a lot. That's energy prices, food prices. It all depends on supply and demand, and anything depends on supply and demand, usually more volatile. Currently, our variable inflation is quite high, where our sticky inflation is still reasonable. So,
there's a question in Q&A. What do you think about target retirement funds for retirement investment?
I really like them. I really like them because what they do is to remove emotional component from investments. And they already like a built meal. You go in, you take everything is there, bonds there, stocks there, other type of investments, and it gives you a target date of retirement. So you take this nice, built for your meal that's already been worked out We know how it tastes, and you just warm it up and you don't need to do much. I like that, especially for those who are in accumulation stage. In the distribution stage, once you're retired, you probably need to build a little different allocation, because you might be more focusing on different areas like dividends, income, reduced risk. But for building up your wealth, especially with the target date funds are low cost, it's a great place to be. And few companies have, T. Rowe Price have the great ones, Vanguard have a great ones. I think Fidelity, many of them have.
Okay. All right. I don't see any other questions.
No, great. All right. So wonderful. Well, thank you very much for the questions and being around. And I'm looking forward to touch base maybe sometime in fall.
Okay. Thank you so much, Larissa.
Thank you very much, Lisa. Have a good one.
Bye, everyone. Have a great
Bye.
week.
Bye.